Welcome to the deep dive. Today, we're jumping into something pretty big, a financial story that maybe doesn't get the splashy headlines, but well, it feels like a warning sign. We're going to unpack why gold prices are hitting these relentless record highs in 2025 and what that might really mean.
Exactly. Our mission here is to connect the dots for you. Using the sources we've gathered, we're linking this gold rally to, well, some pretty fundamental stuff. U.S. government debt, how it's structured, this whole concept of currency debasement, and yeah, even what's happening geopolitically. The goal is for you to understand why some very smart investors seem to be running for cover right now.
Okay, so let's start with the most obvious thing. The visuals in our source materials really pop here. You see gold, that's the orange line on the charts, and it's just climbing faster than the stock market, the blue line. Gold's ahead.
And that right there is the hook. Because historically, looking back over like the last century, this scenario, gold beating stocks, it's only happened maybe 4 times before now. And every single time, it signaled major economic trouble brewing, like flashing red lights everywhere.
Okay, so walk us through those times. Why are they so important?
Well, they matter because each one was a crisis of trust, really. First, you've got the Great Depression, the 1930s, total economic meltdown, right?
Right.
Then the 1970s, that was huge because it came right after Nixon took the U.S. dollar off the gold standard. That led straight into stagflation, crazy inflation, no growth, a real crisis for the dollar.
Okay, I remember hearing about that. Then what?
Then you had the dot-com bust around 2000, all that inflated tech stock value, just a poof, gone.
Yeah.
People realized valuations didn't mean much then.
And the last one before now.
The Great Financial Crisis, 2008, the banks nearly took down the whole global system.
Okay, so depression, 70s stagflation, dot-com crash, 2008 meltdown. And now, number 5 is happening right now, post-pandemic 2020 to 2025.
Exactly. And what's striking now is it seems the big investors aren't chasing big returns, they're prioritizing protecting what they have.
Go.
Which brings us to the core worry, this idea of debasement of currency.
Debasement, meaning the dollar just isn't worth as much, and maybe a debt crisis is coming.
That's the fear, yeah.
All right, so to get this debasement idea, we need to look at the basics. How does the U.S. government actually operate financially? It's not a company trying to make a profit, right? It runs on tax dollars, our money.
Very much. And the numbers for 2025, they're pretty stark. The government expects to bring in about $5 trillion in taxes. That's its income.
Okay, 5 trillion in.
But it's planning to spend around $7 trillion. That's on everything. Healthcare, the military, roads, tech research, you name it.
So 7 trillion out, 5 trillion in. That leaves a $2 trillion hole. That's the deficit spending we keep hearing about. Where does that $2 trillion actually come from?
Right. It has to borrow it. It issues debt. And there are basically 4 main lenders. First, regular folks like you and me, maybe through savings bonds, plus big institutions, banks, pension funds, companies. They buy treasury bonds, hoping for interest.
Okay, so domestic lenders.
Then you have foreign countries, think the UK, Japan, China.
Hmm.
They hold a lot of U.S. debt,
Hmm.
which, gives them a certain amount of leverage over the U.S. economy.
Yeah, that makes sense. And the fourth lender, you said that one's different.
Yeah, that's the Federal Reserve Bank, the
Yeah.
U.S. central bank.
Okay.
And the Fed has this unique power. It can essentially create money digitally, just out of thin air, and then lend that newly created money to the government to cover that $2 trillion gap.
Wow. Okay. And that power got stronger after 1971, you mentioned, when the dollar wasn't backed by gold anymore.
Precisely. Before 1971, if the government wanted to create more money, it needed gold in the vault to back it up, like collateral. Take that away, and suddenly the Fed can pump basically unlimited new dollars into the system.
So no physical restraint anymore. And the direct result of flooding the system with all these new dollars is?
Inflation. Now, most people think inflation just means prices go up, but that's the symptom.
Okay.
The actual definition, the root cause, is the inflating of the money supply. There are simply more dollars chasing the same amount of goods and services.
So it waters down the value of every dollar already out there. Like my $10 bill suddenly only buys what $5 used to buy over time. It's like that shrinkflation thing with chip bags, but for the whole currency.
You got it. And when each dollar buys less, everything feels more expensive. Your rent, your food, buying a car. That's why if you look historically, average wages just haven't really kept pace with this kind of monetary inflation.
Yeah.
It makes it much harder for the average person today to buy big assets, like a house, compared to maybe their parents or grandparents. The goalposts keep moving.
Okay, so bringing it back to gold. If the dollar is being diluted, being debased, how does gold fit in?
Gold becomes the classic hedge. It's seen as a way to hold value outside of that fiat currency system that's being diluted. When you buy gold, you're trying to preserve your purchasing power.
Right. But people always say gold is non-productive. It just sits there.
Right.
Unlike a stock in a company that's actually making things or providing services.
That's the standard view, yes.
Mhm.
It doesn't generate cash flow like a business.
But couldn't you argue it is productive in a different way? Like, its job is to be the stable thing, the geopolitical reserve, the stabilizer in a crisis. Its function is its productivity, maybe, as a failsafe.
That's actually a really insightful way to put it. Yes, it's productive as protection. It's not generating new wealth, but it's aiming to preserve existing wealth. So when you see gold suddenly start doing better than the stock market,
Yeah.
it's a powerful signal. It tells you that investors are becoming more worried about keeping the value they have, protecting it from that dollar erosion, than they are about growing it through investing in businesses. Preservation over growth.
Okay, so preservation is key. Let's get specific then. What are the immediate things happening right now in 2025 that are making investors nervous enough to drive gold to these record levels? You mentioned three forces.
Right. Force number one is, frankly, a bit startling, pulled from our sources. It's this potential gold revaluation proposal. Apparently, back in August 2025, the Federal Reserve itself put out some material, thinking about changing how it values the U.S. gold reserves on its books.
Whoa, wait. Revaluing the gold. How is it valued now? This sounds wild. The U.S. has, what, 261.5 million ounces of gold?
Right. But officially for accounting, it's valued at just $42.22 an ounce, a number basically unchanged since the 1970s.
$42. But gold's trading way, way higher than that. Why keep such an old number?
It's sort of a historical quirk. It kept the balance sheet value looking stable, artificially low. At $42 an ounce, the entire U.S. gold reserve is listed as worth only about $11 billion, which is tiny.
Okay, so what was the proposal?
The idea floated was to revalue it closer to the market price, or maybe even an aspirational price, like, say, $3,300 an ounce.
Okay, simple math here. If you go from $42 to $3,300 an ounce for 261.5 million ounces, that takes a value from $11 billion to, what, around $860 billion?
Exactly. You'd basically create $850 billion in value on paper just by changing an accounting entry.
And what could the government do with that $850 billion of extra paper value?
Well, that's the crux. It could potentially be turned into actual cash.
Yeah.
The Treasury could issue a sort of gold certificate to the Fed, get cash in return, and use that $850 billion to pay down debt or fund new spending, like a massive stimulus.
Okay, that sounds like a magic money tree, but what's the catch, the risk?
The risk is huge. Gold prices are volatile. Remember they soared and then crashed after 2011, 2012, when those immediate crisis fears faded? If the government spends that $850 billion and then gold prices fall sharply, the Fed is left holding the bag with a massive loss on its balance sheet.
And that makes the Fed look unstable, which could spook foreign lenders. They might demand much higher interest rates to keep buying U.S. debt if they think things are shaky.
Precisely. It could trigger a confidence crisis. So that's force one. The mere discussion of this revaluation is making markets jittery.
Okay, scary stuff. What's force number two?
Force two is the whole de-dollarization push, especially from the BRICS countries, Brazil, Russia, India, China, South Africa. They're actively looking for ways to trade amongst themselves without using the U.S. dollar.
Right, I've heard about this. They're even talking about maybe creating their own currency, possibly backed by gold.
They are. And this is a direct challenge. The U.S. dollar is a fiat currency. It's backed only by faith and credit, really. Its power comes from being the world's default currency for trade, the reserve currency.
So if global trust drops and countries start ditching the dollar for trade,
it hits the dollar's value hard, and it weakens the U.S.'s ability to just print money to cover its spending because fewer people internationally want to hold those dollars.
And this ties back to gold demand.
Absolutely. Look at central banks, especially in places like China and Russia. They are buying physical gold at the fastest pace in decades, according to the sources. They're reducing their dollar reserves and adding gold.
So it's not just investment demand, it's strategic geopolitical demand soaking up a limited supply.
Exactly. Driving prices up. They're hedging against the dollar, against potential U.S. sanctions, against instability.
Okay. Force one, revaluation risk. Force two, de-dollarization. What's the third force driving gold now?
Force three is simply the sheer scale and persistence of U.S. deficit spending. We talked about the $2 trillion deficit for 2025. The problem is this high level of borrowing hasn't gone back down after the pandemic emergencies. It seems baked in.
Right. You mentioned the numbers earlier. It's worth repeating the trend.
Yeah, look, 2019, pre-pandemic, the deficit was just under $1 trillion, about $984 billion. Then boom, 2020, pandemic hits, $3.1 trillion deficit. 2021 still high, $2.8 trillion.
Okay, emergency spending.
Then 2022, it drops to $1.4 trillion. You'd think, okay, we're heading back towards normal. But no. 2023, it went back up to $1.7 trillion. 2024, $1.8 trillion. And the estimate for this year, 2025, is $2 trillion.
So we're running deficits more than double the pre-pandemic level, even years after the crisis phase. It looks like an addiction.
That's exactly how the sources frame it. There seems to be very little political appetite to cut spending back.
But hang on, there's always the argument that government spending fuels the economy, right? It's a huge part of GDP. If the U.S. economy is, like you said, addicted to this spending, wouldn't cutting that $2 trillion deficit cause a massive recession? Is that calculation that it would be worse than 2008, maybe overblown? Could the economy handle it?
Well, the sources we looked at suggest it would be incredibly painful. Think about it. U.S. GDP is roughly $30 trillion for 2025. Government spending is $7 trillion of that, including the $2 trillion deficit. If you just yank that $2 trillion out overnight, that's a nearly 7% hit to GDP, 2 divided by 30. The 2008 recession saw GDP shrink by about 4%. So yes, the math suggests a deficit cut of that size could trigger a contraction significantly worse than 2008.
Wow. Okay, so it really highlights this dilemma. Cut spending and risk a deep recession, or keep spending, keep printing money, and risk further debasing the currency.
That's the tightrope. And if you pull back and look at the big picture for you, the listener, this reliance on government spending, funded by creating money, tends to exacerbate inequality. As the dollar loses value, assets owned primarily by the wealthy, like stocks and real estate, tend to inflate in price, while wages for the middle and working class lag behind. The purchasing power erodes.
So wrapping this up, what's the main takeaway for someone listening? This gold rally isn't just noise.
No, it's a signal. It's informed investors reacting to these deep structural issues with U.S. debt, spending, and the dollar's future value. Gold historically is where capital flows when that kind of foundational trust gets shaky. It's acting as protectionary capital.
Not necessarily for growth, but to protect what you have.
Exactly. Understanding why gold is moving now helps you grasp the potential risks out there in the financial system. We know the U.S. national debt is now over $37 trillion. We know recessions happen fairly regularly.
And $37 trillion. That's just a staggering number. It makes you wonder what possible solutions are even on the table. I know one source mentioned President Trump floating some pretty unconventional ideas involving gold, even crypto, to tackle that debt. It's certainly a provocative thought.
It is. And whether those specific ideas gain traction or not, the core issue remains.
So the real question for you, the listener, is how understanding the cycle, this dynamic of debt, potential debasement, and the signals like rise in gold can help you prepare. How can you build a more resilient portfolio for whatever the next economic downturn might look like? Because eventually, one will come.
Thinking strategically about protecting your purchasing power seems more important than ever.